Hello friends, today I am going to talk about balance sheet reconciliation relating to provisions covering Ind AS 37. So in this session I am going to talk about what is the meaning of provision, when we should account the provision, how to determine the provision, and at the last I'll talk about when you do the reconciliation, month-end reconciliation or quarterly or yearly, what are the activities you are going to perform and what you are going to check to ensure that the provision is accurate. Let's understand the meaning of provision defined under Ind AS 37. So provision is a liability of uncertain timing or amount. These two words is very important, uncertain timing or amount. Okay. And it relates to what? It relates to a liability. Next, what is liability? Right? It is a present obligation arising from past events, the settlement of which is expected to result in an outflow of future economic benefits from the entity. Okay. I know you are confused by saying strong English sentence here now, but I'll break down each words and explain you what is the meaning of that. Right. So what is the meaning of present here? Because it is a present obligation, right? What we saw the definition of liability. So what is the meaning of present here? Which is in existence as on the balance sheet date and is probable based on evidence available on the balance sheet date, right? That means there is an event on the balance sheet date and that event is creating an obligation on the company, right? Let's understand what is the meaning of probable. It means more likely than not. That is, the probability of occurrence is greater than non-occurrence. That means you have to settle your obligation. You have to make a payment. You have to ensure that the obligation as per the contract is fulfilled, right? So it says that the probability of occurrence is greater than non-occurrence. If it is non-occurrence, then it is like a contingent liability. Either I pay or I don't pay. But if the probability of occurrence is greater than non-occurrence, that means yes, you have to pay, but the estimation can be high, low based on the judgment. So if the probability is that you have to pay, then you have to create a provision. Now let's understand obligation. This is very important, right? So obligation is a responsibility to act in a certain way arising from binding contracts, statutes, or business practices, customs to maintain good relationship. That means the obligation should be a contract. Means it's coming from a contract. If there is no contract, then there is no obligation, right? Then you need not create a provision for it. Then statutes. For example, the government changes the rule saying that okay, whatever you have sold in last 6 months, you have to pay 1% extra tax now. So you have to create a provision for that, right? Because there is a change in statutes. You can't say that I don't have a contract with the government, hence I'll not do it, right? So statutes applies to all companies. And the last one is business practice. Sometimes it may happen that you don't have a legal contract, but as to keep a good relationship, you may offer some benefit to the customer, right? Sometimes you may see that okay, after warranty period, the company still provides some benefit to the customer because the customer has taken a bulky order, for example, and the business want to keep him happy or to expect future growth of sales, the company may afford extra cost or incur extra cost for the customer even though it is not part of the legal contract. In that case also you need to create a provision. Now let's try to understand the meaning of past events. This is very important because in the definition it says that the obligation should be connected to the past events. So if the past event is not there as on the balance sheet date, you need not create provision. So understanding the meaning of past event is very important so that you create right provisions. Now, past activities are obligation events where the entity doesn't have an alternative to skip such an obligation. It is either legal obligation or constructive obligation. It means it should act in some manner to settle the obligation. That means it is very clear that there should be an illegal obligation or constructive. Constructive means the example what I gave in the previous slide, where based on the business practice, even though there is no legal contract, you still give some amount of benefit to the customers or suppliers, right? Now, past activities means there is a event which has occurred before the balance sheet date or as on balance sheet date there is a event occurred and that is triggering an obligation which is not settled on the date of balance sheet, right? Now let's take an example so you'll have more clarity about the meaning of past events. ABC Limited is a car manufacturer and provides warranty benefits to its customers for 1 year. Okay, so car manufacturer is giving warranty benefit to its customer for 1 year. ABC estimates that warranty cost will be approx 10,000 rupees per car. During the month of March, ABC Limited has sold 100 cars. Whether ABC Limited has to create a provision for warranty. So it is a very simple, case. Let's understand whether ABC has to create a provision for warranty or not. Now, before starting the solution, let's understand the meaning of provision defined under Ind AS 37. So, provision is a liability of uncertain timing or amount. This is what we understood in the previous slide. And liability is a present obligation arising from the past events, the settlement of which is expected to result in an outflow of future economic benefits from the entity. Now, here, what is the meaning of present obligation in this particular case? Binding contracts with the customer to provide warranty. Okay, so this is a legal contract which the seller or ABC Limited is having with the customer, right? So there is a present obligation. Second, past event. What is the past event here? Sold 100 cars as on the balance sheet date, right? That means if the company would have not sold these cars, we would have not discussed about the provision for warranty, right? Because the past event is not there. Now the company has sold 100 cars, so it has triggered an obligation connected to that contract, that is provision for warranty. So the past event here is sales made by ABC Limited. Outflow in future, what is the meaning of that? Yes, there will be outflow for all the warranty claims from customer. So when tomorrow customer will come for warranty claim, the company has to reimburse either directly to the retailer or through the dealers. Uncertain timing or amount? The answer is yes. The company is not sure when the claim will be made. So timing is not certain, as well as for what amount. Okay, you have a maximum limit of 10,000, that is fine. But it may go beyond 10,000 as well, right? Nobody knows what is the warranty claim. So in this case, provision for warranty to be accounted is 100 into rupees 10,000, that is 1 lakh rupees. Now, question is how this 10,000 is determined? It depends on the management, the estimate they have done based on the historical data. So sometimes it may happen that when the product is launched for first time, they may not have the historical data. They would estimate some amount, but after 3-4 years, they will see the trend of the provisions created, the trend of claims. They'll match that and see that whether sufficient provision is created in the books or not. Based on that, a best estimate is created, and based on that, the provision will be created. Hope you are clear with this example. I'll have another example in the next slide, which will give more clarity. Now let's take another example to understand more about provisions. ABC Limited has an agreement with XYZ Limited to provide consultancy service on tax related activities. During the month of April, XYZ supported in tax work, and by 30th April, ABC Limited did not receive the invoice from XYZ. As per the contract, ABC Limited has to pay rupees 10,000 to XYZ Limited for the work performed, whether ABC Limited has to create a provision for the consultancy fee. So what is the situation here? The service is received by ABC. However, the invoice is pending and not yet received by ABC. So ABC could not process the invoice because XYZ has not generated the invoice, or it may be a situation that he has generated but it has not reached the finance department to process the invoice as on the date of preparing the balance sheet. Now let's see whether we need to create a provision for this or not. So definition is very clear. Provision is a liability of uncertain timing or amount. Liability is a present obligation arising from past events, the settlement of which is expected to result in an outflow of future economic benefits from the entity. So, what is the present obligation here? There is a binding contract with a supplier to make payment for the service received, right? So, there is a contract between ABC and XYZ. So, that is the present obligation what the company has with the supplier. Past event, XYZ has supported in tax related activities during the month. So that means you have received the service, right? So that is the event which has occurred. By the time you prepare the balance sheet, the service is received by the company. Outflow in future, yes, there will be outflow when the invoice from ABC will be accounted by the finance team. And the last is uncertain timing or amount. Amount is certain here because as per the agreement, you are going to pay a fixed amount, for example. But uncertainty, they are related to timing because payment can be released only when the invoice is received and the same is processed for payment, right? So amount is fixed, but timing of payment to the vendor, it all depends on when we receive the invoice. So here the company is going to create a provision for rupees 10,000 rupees because the service is received. There is an obligation connected to the past event, and the outflow will happen in future date after the balance sheet date. Now question is how this provision is disclosed in the financial statement. Where do I report provisions when I prepare the balance sheet, right? And I'll tell you many people get confused here because this provision word is used in financial statement in different places. Okay. Let's see what are the different areas provisions words is used and why people get confused, and let's understand how it is reported. So provisions reported in financial statement can be classified into two categories. One is provision for expense liability, what we understood now under Ind AS 37, correct? It is a liability. You have to keep in mind that provision means it is a liability, nothing else. Now, there is provision for losses as well, okay? And this is covered under this different Ind AS. I'll come back later and I'll show you the example as well. So provision for expenses, which is liability under Ind AS 37, is very clear. It has to be reported as other current liabilities, right? Because it is a liability. And examples are like provision for service received, invoice not accounted, provision for warranty, provision for statutory liability, right? Now coming to the right side, which is quite interesting and many people get confused. Provision for losses is always reported as adjusted with the respective asset. Okay. That means when you create a provision for loss, you are creating this provision against one asset because you may fail to recover. You may see that the fair value of that particular asset is reducing in the market. Hence, you are taking the provision. Okay. You are not going to pay anyone, but the term provision is used. But many people get confused with that provision with the provision for expenses. So what are the example of provision for losses? Like provision for bad debt, provision for inventory obsolescence, provision for unutilized tax credit. So all these items you are not going to show as current liability. This will be shown as adjusted amount from the asset. So under trade receivable, you will see less provision for bad debt. If you have a inventory in your financial statement, the obsolescence provision will be netted off with the inventory and net inventory will be reported. Not that the provision for inventory will be shown as a current liability. Okay. Hence, it has to be adjusted with the asset because the loss or the write-off provision what is created is against one asset. Right. Hope now you are clear. Provision for expenses Ind AS 37 to be reported as current liabilities or non-current liabilities, but it is liabilities. Whereas in case of losses, it has to be adjusted with the respective assets. Now let's understand if you are responsible to do the reconciliation for provisions, what are you are going to check? What are the activities you are going to perform to ensure that the provision reported in the financial statement is correct? So below are the items which need to be checked and reconciled. The first one is aging analysis of provision, right? So all old aged items has to be reviewed and specific reasons should be mentioned for holding it for future, right? Because you need to justify that why this provision should not be reversed, why the provision should be continued in future period. So specific remarks, it may happen that you may not have the details available in the finance team, but you have to reach out to the business team who has control on this provision or who have more information about this provision. Check all backup documents for all old age items and documents justifying to hold the provision in the books. Sometimes it may happen that the business explains you, but as to double check to ensure that what they explain is as per Ind AS 37, collect all the backup documents and check that whether you should hold this provision or not. Coming to the second point, review of ad hoc provisions. Ad hoc provisions are very dangerous because sometimes it happened that many people just give a amount that please take a provision and finance team blindly they post these entries, which is not correct. So all provisions has to be based on conditions explained under Ind AS 37. All provisions accounted should have legal or constitutive obligation and arising from past events. This is clear definition under Ind AS 37. Ad hoc provisions should be reviewed in detail to understand the background. Okay. And always mention the comment also that why you have this ad hoc provision. There should not be any accounting posting because of budget allocated for that period. Certain time it may happen that the controllers, business controllers, they push the accounting team that you post this entry, I have a budget for the current month. Please don't do that. That is not correct. Because Ind AS 37 explains very clear that there should be a obligation arising from past events. Not that in future you're going to spend and you accrue the expenses today. Not allowed. So ensure that whatever ad hoc provision the controller or the business is suggesting has proper backup documents and Ind AS 37 terms and conditions are fulfilled. Coming to the third one, reversal of provision. Provision has to be reversed only when the invoice is received for accounting or there is no need for making the payment. Correct? That means if it is accounted, you have to reverse it. Or tomorrow business says that as per the legal requirement, we need not hold this provision going forward. You can reverse that as well. Ensure that reversal of provisions are accounted correctly. There should not be a situation where invoice is accounted and provision also not reversed. So what will happen in that case? This will create duplicate impact on P&L and balance sheet because you have a provision at the same time you have created the expenses again by processing the invoice. Next point to check is reporting a financial statement. As we explained in the previous slides, that it has to be shown as a liability, not to be netted off with any asset. Only provision for expenses has to be netted off if it is created for any asset. So ensure the provision created for assets is not reported as current liability, right? It's not happened that some provision were created for, against any some asset and then the same has been reported as current liability. That is wrong. Classification of current and non-current provisions. Ensure that whereas as per the contract, the liability has to be discharged after 12 months from the date of balance sheet, those provisions has to be reported as non-current. Okay, don't show as current because that is not right disclosure. So if my liability has to be discharged only after 12 months from the date of preparing the balance sheet, I need not show as current. I will report as non-current provisions. So that's it about provisions. The balance sheet reconciliation, what I explained, need to be verified. I am going to prepare few more series on balance sheet reconciliations. Already in the channel, you can find about trade receivable, fixed assets. This is the third video which I am publishing. I'll be happy to take few more topics. If you are interested, please let me know in the chat box. If you like this video, please like and share with your colleagues so that they understand more about financial terms and provisions. Thank you.